Welcome to The Explainer. Today we're digging into a really provocative idea. What if the engine room of innovation, venture capital, is actually broken? And what if the problem isn't some external force, but something rotten on the inside? That's the argument we're going to unpack.
And this quote from Peter Thiel, it just perfectly nails what venture capital was supposed to be about, right? It was this hunt for secrets, for those contrarian, non-consensus ideas that everyone else thought were crazy, but that could literally change the world. It was a game of pure conviction. All right, so here's how we're gonna break this down. First, we'll look at the contrarian ideal. Then, we'll dive into the consensus crisis and a way to measure it called the arrogance score. After that, we'll see how the power law got corrupted, the squeeze on early stage companies, and finally, the proposed cure: own an island. So, first things first. Before we can really talk about what's wrong, we gotta set a baseline, right? Let's look at what a healthy, functioning venture capital world was actually supposed to be.
So on the one hand, you had the ideal. It was all about individual conviction. An investor would go deep, really deep, building up this unique, asymmetric knowledge to find those hidden secrets and back the true outliers. But look at today's reality. It's almost the complete opposite. It's herd behavior. It's just chasing the same signals, the same elite schools, the same resumes, and basically outsourcing your thinking to whatever the big guys are doing.
Okay, so what does this shift actually look like in the market? Well, let's just say the warning lights on the dashboard are flashing bright red. We're talking about some pretty alarming symptoms.
The first and maybe the most shocking symptom is just this insane concentration of capital. 41%. Just think about that for a second. Nearly half of all venture dollars in the entire US this year went to just 10 companies. That's more than double the record for the last decade. It's wild.
And it's not just the startups getting all the concentrated cash. Nope. The same thing is happening to the VC firms themselves. In 2024, just 9 firms, you can count them on 2 hands, sucked up over half of all the capital raised by all VCs. The money is just flowing into a smaller and smaller pool. The source we're diving into today has a great name for this: the mind virus of big venture. It's this idea that as a few giant funds get bigger and bigger, it's like their thinking infects the whole system. Everyone else just starts mimicking them, which leads to this really dangerous situation where everyone's chasing the exact same deals and truly original ideas, well, they're left out in the cold. Okay, so here's the crucial part. This isn't just a gut feeling that something's off. We can actually put some numbers to this to see just how distorted the market has become. And frankly, the math behind some of these giant funds, it's getting really hard to justify. And a brilliant way to do that is with this concept called the venture arrogance score. Now, stick with me here, it's pretty simple. It basically measures what percentage of all the future money made from VC-backed exits a single fund would need to grab just to give its investors a pretty mediocre 3x return. Okay, so look at these numbers. For context, anything over 10% is considered like heroic, once-in-a-generation performance. Well, the average top funds are already pushing that. But then you look at a rumored $20 billion fund from a firm like Andreessen Horowitz, and its score is 74%. That's not just heroic, that's basically saying you believe in magic. It's a number that defies logic. So you really have to ask yourself, does it seem even remotely possible that one firm could capture almost 3/4 of all future tech value just to deliver an average return? The math just doesn't work. It's as simple as that.
So how on earth do these funds justify this kind of strategy? Well, it turns out they do it by taking a core principle of venture capital, the power law, and twisting it into something it was never meant to be. So the original idea of the power law was pretty straightforward. It says that, look, a tiny handful of your investments are going to deliver almost all of your returns. So what does that mean? It means you have to be a contrarian. You have to have the conviction to find those weird, rare outliers that nobody else sees. It was all about taking non-obvious risks. But that idea has been completely corrupted. Today's version is basically this: be a price-insensitive index. What that really means is pay whatever it takes to get a piece of any company that everyone already thinks is going to be a winner. See the difference? It's not about finding secrets anymore. It's just about fighting for a slice of the obvious pie. And this quote from a partner at a 16Z just says it all out loud. He says, what matters now is access, winning, and having the right fund structure to enter the casino. A casino.
It's not a game of insight anymore, it's a game of access. It's about being able to get a seat at the table where everyone else is already betting. Conviction is out and the casino is in.
Okay, so what's the big deal? What are the actual real-world consequences of all this? What does this mean for the next generation of startups? The ones that are supposed to be building the future? Well, this chart tells a pretty stark story. Just a decade ago, 2/3 of all VC deals were these small, early-stage rounds. The seed corn of innovation, where new, unproven ideas get a chance. And today, that number has been chopped in half. The little guy, the small deal, it's getting squeezed out. And what's so weird is that it creates this paradox. The number of seed rounds has totally cratered, down almost 50% since 2021. But at the same time, the valuations for the lucky few that do get funding are way up. It's creating this world of haves and have-nots. A few hot companies get showered with cash at insane valuations, and everybody else, well, they're left to starve. So, is it all just doom and gloom? Is venture capital broken for good? Well, not necessarily. The source we're examining actually lays out a pretty clear path forward for anyone who wants to escape this consensus trap. And the cure isn't about trying to beat the mega funds at their own game. No way! It's about playing a totally different game. Stop trying to mimic the big guys. Instead, out-specialize them. Go so deep into one specific area that you build knowledge nobody else has. The idea is to find your island, a niche that you can completely, utterly own. I love this metaphor, being the king or queen of your island. It's so powerful, right? It's not about being pretty good at a lot of things. It's about being the undisputed best in the world at one thing, dominating a niche you understand better than anyone. That's how you get back to real conviction. That's how you find an edge. And all of this really leaves us with one final massive question. If the people whose job it is to fund innovation are all just chasing the same handful of ideas, then who's left to fund the ideas that will actually change the world? Who is funding the weird, the non-obvious, the next great conspiracy? And that, right there, is the real challenge for the future of innovation.